Hey guys, on today's episode, we are taking a look at the state of angel investing in the summer months here in August. I will have David Friedman joining me shortly, and we'll particularly dig in to valuations. So stick around. Hello, David. How are you today?
Never been so good. Now that I see you dressed in your entrepreneur garb, and I'm
Yeah,
dressed in my investor garb.
exactly. You've got your bright yellow shirt on there, and yeah, I'm I thought the entrepreneurs are supposed to be hoodies and everything, but I actually have a collar on, so I don't know what happened.
I did this because we had the hurricane, a few days ago, and I decided to be sunny today.
There you go. There you go. Keeping the weather good. Awesome. Well, hey, I thought it would be a good time, and actually, you also felt it would be a good chance for us to talk about what we're seeing in the screenings, what we're seeing here in the summer around valuations, the state of angel investing, especially for TCA Orange County or any other data points that you might have. So, why don't we dive in, David? What are you seeing out there?
Yeah, well, I was on a call the other day with the Angel Capital Association operating people, and these are all the heads of not all the heads, but a lot of the heads of the angel groups around the country. And we're seeing quite a lot of deals coming through. Many people think that the deals are slowing down and we're not seeing good deals. We're actually seeing many deals, but they're focusing in certain areas more so than in others.
Oh, really? Okay. All right. So, where is the focus these days?
Yeah, so we're seeing deals, a lot of AI. AI is becoming a buzzword. We can get into is it real AI or is it algorithm?
Uh-huh.
We're seeing deals in immunology. We're seeing deals in cancer diagnostics and diabetes diagnostics. We just completed a deal on in medical devices. One with Limber, we had single pass on a few weeks ago,
Yeah.
and we're seeing just the general technology deals that are coming through in fintech, ad tech, martech, X tech, whatever you want to call it. So we're seeing a plethora of deals coming in. The issue is finding the right deals, of course, and at the valuations that we want to invest in, which is really the key.
Yeah. So, why don't we divide and conquer here? Obviously, AI is super hot. So, let's talk a little bit about AI and what we're seeing. Let's start with, what kind of problems are these AI companies solving? What has stood out to you?
Yeah, I'm still trying to figure that out actually, and I'm being very serious. There's always it's like there's always an AI complement. For example, in the diagnostic area, they're using AI or AI models to look at lots of data and be able to figure out how that data can be applied to immunology, how that data can be applied to diagnosis, of certain diseases. They're using AI to basically take massive amounts of data and then refine it to come up with a few key themes that they can act on. And
Yeah.
then when they do something, they'll put the data back in the system to try to find out, how that interacts and what changes. So
So,
whether or not it's an algorithm or AI learning, I don't know. That's something to investigate.
well, the big push these days is generative AI, which is different than machine learning that has been around for many years. And generative AI is able to actually produce outputs, whereas before, machine learning would find patterns in the data. So, what I'm hearing is you're getting probably still some machine learning where they're, let's say, looking at 100,000 or a million images of cancer, and then using a machine learning algorithm, they're able to say, oh, this mole is cancerous versus not, right?
Right.
But
And we've seen that for a while. We've seen those
exactly.
things actually in dermatology. Yeah.
Yeah, yeah. But what I'm seeing is the use of generative AI to actually produce solutions for a customer. So there's a lot of marketing companies now, sales companies, where they'll generate your emails for you, create, they're advertising that they can create leads, that they can book you more meetings, AI being set up as bots to answer questions for customer support or for internal knowledge. So I'm assuming the newer AI companies that we're seeing are on the generative AI side. This is the hot space, I would say, right now. There's a lot of hype around AI. So David, what is the expectation that entrepreneurs come in with evaluations? Are they, let's just say, are they single digits or are they double digits?
Well, most of the ones that we're seeing are double digits. I mean, the
Okay.
issue goes back down to what are you really using as the underlying technology? Do you have an advantage? And in what area? For example, we know that the hot areas are predictive medicine, immunology, some medical device. We know in the case that you indicated in marketing, the MarTech arena, in CRM systems, I now can track and use generative AI to be able to write the right letters, keep track of the responses. So when you couple that with the areas that are hot with the use of the word AI, you're
Yeah.
seeing people come in with, well, 15 million, 20 million. We even saw a $30 million valuation, but that creates a problem for at least the angel investors that we can talk about, and why that's a problem, and why we explain why the issue is such we don't want to invest.
Right. So I think we've covered in other episodes where TCA angel groups are looking for a 10x. So if you're coming in with a 30 million pre-money valuation, we need at least a $300 million exit. And if we don't see that clearly, then it's going to be difficult to entertain that, right?
Well,
So
but it's even worse than that. It's even worse because what happens in most cases, we're angel financing. So we're early round. We may be seed or bridge.
yeah,
But if they now have a finance strategy, a funding strategy saying they want to get another equity round or two equity rounds, now that 300 million has to be 400, 500, 600
right.
million. And the probabilities go down when you start seeing these massive deals.
Yeah, yeah. However, though, like being at the beginning stages of this AI revolution, do you think there's a lot more opportunity now to create billion-dollar companies? And do you think these companies are flowing through TCA?
I wish I had that in my crystal ball, but I don't. I
Yeah,
do think that AI and the technology incorporating either AI as a platform or using the AI technology will make a company more valuable and will enable the company to get to market faster potentially and offer more features through AI. But I don't know if it's going to create more high valued companies than what we have today. It all gets down to, again, the team and the product, the product market mix more so than the particular underlying technology. But in certain areas, it certainly has the potential in predictive medicine and immunology, in cancer research, to create more companies that have more value to their
sure.
clients or the customers.
But I guess my point being, it's early days. There's a lot of room ahead to kind of become market leaders. These companies may become market leaders because they are first movers, early movers. Although, as we saw, Facebook was like the number 7 player in the social media space. Early movers don't always take it. But let's come back to valuation. So if companies with $30 million pre-money valuations are likely to not get a deal at TCA, do you see a $15 million valuation if it's compelling enough?
We see 15 million valuations, but let's step back for 1 second. You're an entrepreneur. I'm serving the role of the investor. So it could be a point counterpoint like the old days in TV. What the entrepreneur should realize is that when we are looking at this exit, we're looking at it for a specific reason, because out of the angel deals, which are real early deals, we see a lot of failure, unfortunately. It's tough for the entrepreneur to accept that, but there's a lot of failure. So 6 out of 10 companies may fail right out, and hopefully, they fail fast and go on to the next great deal. But we have to make it up for that 1 or 2 deals that really have that significant bump in the valuation or the exit. So that's the reason why we look at things a little differently than the entrepreneur. When an entrepreneur comes in and they say, we have a deal that's at 15 million, we ask them, how do you justify it? And a lot of the justification could be that the technology is there. We're using AI, and AI, it's like the old days in 2000 when everyone was putting a .com after the name. We saw valuations increase, but there was no substance.
Yeah.
We believe there's a lot of substance, but we have to question what is that substance and what's the relevancy of that technology to the product market fit. So you have to be able to show and prove it if you have something unique. If you're approaching a problem in a different way and you have a great team, a valuation of 15 million with a big market shouldn't be too much of a problem. We can see even with another round or two of financing a good exit, but you just can't throw it out there without that understanding and the background. What's the background of the business model? How are you going to make money? What's the logic? How are you going to go to market? How are you going to shape the market? So it's just one component of valuation. So we don't have a problem with the valuation per se. It's the reasonableness relative to these other factors that's the criteria we have to look at.
Right. All right. So thank you for that. So AI, you're seeing pretty high valuations. What other notable sectors are you seeing valuations that we can comment on?
Well, again, AI is a tool in many of these other sectors. So when we look at the sectors, again, predictive medicine, immunology, cancer treatment, diabetes treatment, medical device, throw 3D printing on a large scale like Limber Technologies, Limber Prosthetics. So we're seeing those areas having a high potential. Those are the hot areas right now.
You mean just
I guess throwing
being in an
solar and
industry?
sorry?
I was saying, like, you're saying what you're seeing is you take a traditional industry and then you apply AI to it, and that's the bulk of the deals coming through.
Not necessarily. We're seeing, again, you're looking at AI as the end game in a sense. I'm looking at, and I think many of the investors are, we're looking at AI as a supporting technology
Yeah,
to
that's.
solve
I'm
a
saying the
problem.
same thing. I'm saying the same thing. I'm saying you're seeing a lot of deals come through in different industries, but some of them throw on the AI. But let's go back to valuations, though, David. So, what else are you seeing as far as valuations? That's exciting and interesting.
Well, I'm not sure it's exciting or interesting. We're seeing a lot of deals come through, and again, in the medical area where we have valuations 15 to 18 million pre-FDA clearance, and those seem to be acceptable, especially if there's some uniqueness, maybe some technology coming out of the universities. And we do some work, as you know, with UCI. The university has generated a lot of both engineering patents as well as medical patents or medical technologies. And those things, those technologies and the potential for commercialization will probably support a fairly high, relatively speaking, valuation. The point on all this, Costin, is in the early days, we used to say we're looking at, in TCA, we're looking at deals in the $3.5, $4 million range. We do see some of those right now, but we're seeing more towards the high single digit, low double digit, and higher. We just have to select and choose which ones, and we find that out through our due diligence process. So valuations are important, but not the end all be all in terms of us making a decision.
Got it. So as we wrap up here, getting towards the end of our 15-minute segment on valuations, what other tips can we have out there for either entrepreneurs or the investors looking at deals? What's the right range? You're saying 15 for a seed stage deal right now is kind of what you're seeing be the market?
No, I don't want to give that illusion that $15 million is okay. It has to be relative to the technology, the product market fit, the team, and a variety of other factors. What I'm saying is that let's start with the investors. The investors have different philosophies and different risk profiles. Some investor groups are okay with doubles and triples, getting a 5x, a 6x return. Other groups that take higher risk want a higher return or a potential for the higher return. From the entrepreneur point of view, what I suggest that all entrepreneurs do is work with their advisors, look at what's happening in the market and come up with some benchmarks in that area that they're focusing in that product set, in that market set, what have the valuations been? What have the exits been? That's what they're going to have to show, be it TCA, be it Meta Angels, Pasadena, whichever. They're going to have to show and prove that this is in the realm of reason. So they have to be able to set their expectations correctly by looking at the data. Okay,
Yeah.
that's
Yep.
important. You just can't come up with a wild hairy scheme. It's not a BHAG. I'm going to get a 15, 20 million
Yeah.
valuation.
Well, and we've provided a little bit of data on this episode here. You've given us some data points on what you're seeing. Any other suggestions where these entrepreneurs can go and look for the market data and calibrate themselves properly so that they don't look silly when they get in front of investors with a ridiculous valuation ask?
Well, I don't think anyone's going to look silly. Let's
Oh,
make sure.
of course, those guys
This
asking
is a
for 100 million,
negotiation
they're
more
gonna
so
look
than
pretty silly.
silliness. But what I would recommend the entrepreneurs do is, they can look at their advisors via the, accelerators or the small business development centers. They can help. I would look at data from Crunchbase, from CB Insights. I would look at some of the data from Capital IQ or PitchBook if they have access to those. It will at least give an indication of what valuations are at the same state they're in and what the potential exits have been. And I think that will at least put a box around what the valuation is. So what the entrepreneur should say or think about is, here's my low point, here's my high point. Okay. And here's the box that I'm playing in, and be somewhat flexible. Because it's, again, valuations is a negotiation. It's what we believe is acceptable based on our investment thesis and what's acceptable from the entrepreneur point of view in terms of what they want to get compensated at a point in time of an exit. So I think that's the sum in my mind.
Yeah, I think positioning as a negotiation is key. At the end of the day, it's a sale. You're either selling a piece of your company for a certain price, or you're selling, convertible notes or whatever. So it is a negotiation. Hopefully, this episode provided some insights onto the current state of angel investing, where it comes to valuations and what TCA is seeing. And thank you for watching. Make sure to hit the subscribe button. Make sure you hit the like button. And we'll see you next time. Take care.
See you,
Bye-bye.
Costa.
Bye.